Good morning, everyone, and welcome to the Daily Trader with Kevin Hincks. I have two paper money trades for you today. Two names that are in the news. We've got Tesla that Dan Ives came out with a note on, put a $500 price target on. And then we've got Apple coming under the watchful eye of the Trump administration with 25% tariff. So let's get to our first trade of the day, and that is Tesla. Now, Dan Ives came out this morning, the Wedbush analyst on the Schwab Network quite often, and gave a $500 price tag and a big upgrade to Tesla this morning. Can't really hide from the market being down. However, the stock down about $5.50. So we're going to look at a trade that we don't talk about too much on the show. It's called an unbalanced butterfly. And this is from the call side going out to the June 13th expiration. Here's what we're going to do. It's in the butterfly family, but we're going to skew it, and I'll show you how. We're going to buy the 350 call, buy one. Then we're going to sell two of the Tesla June 13th 400 calls. All the strikes are in the same expiration. Buying the 350, selling two of the 400 calls, and then buying one of the 420 calls. So a $50 call vertical, and then a short $20 call vertical. You'll see on the graph there on the risk profile how it moves up towards that short strike like a butterfly does to $400 where it peaks out. But on the upside, because you're long a $50 call vertical and short a $20 call vertical, it holds on to some of its gains on the upside. That's one way you can take a butterfly strategy and skew it to your opinion. Now, this is a bullish trade. The risk on the trade is whatever debit you pay right now. It's looking about $9.20 is where we put in, trading about $8.75 now. So that would be the risk on this trade. The break even, it's the long strike, in this case 350, plus whatever debit you pay for that spread. That's where this breaks even. So an upside play in Tesla using the butterfly strategy where we buy a $50 call vertical, sell a $20 call vertical. The target being that $400 strike, and the risk is the debit paid. All right, let's get to our second trade today, and that is Apple. Now, Apple, the Trump administration, I'll read you the quote that the Trump administration put out this morning. It is, "I have long ago informed Tim Cook of Apple that I expect their iPhones that will be sold in the United States of America will be manufactured and built in the United States, not India or any place else." And then he said any phone made outside the U.S. would have a 25% tariff on it. Now, that starts some negotiations, I'm sure, with Tim Cook and Apple. But the trade we wanted to look at here in paper money is this. Moving out to the June 13th, same expiration on both trades today, June 13th, looking at the expected move out to June 13th, which currently sits around $14. Stock trading $197. We went just a tad inside that. Sold the 185, 175 put vertical. So selling a downside put vertical. If you know about a short put vertical like this, it is profitable in 3 of the 4 scenarios. If the stock goes up, if the stock is unchanged, or if the stock goes down slightly but doesn't violate that 185 strike. We put it in for a credit of about 165. It's trading about 135, 140 now because Apple has come off its recent lows here and traded a little higher as the market is firming up a little bit off the lows. So whatever you sell this short put vertical for is the max profit on this trade. The risk, the difference between the $10 strikes and the credit taken in. If it's 135, it's 865, right? If it's 150, it's 850. You get the math on that. $10 minus whatever credit you take in, and the credit you take in is the max profit on that trade. So using the expected move in Apple to put on a short high probability short put vertical in Apple. We also did an upside play based on Dan Ives' note out today in Tesla, an upside unbalanced put butterfly. So that's our show for today, everyone. Have a great long weekend. We'll see you next week with another edition of The Daily Trader. I'm Kevin Hincks.